What's going on, everyone? We're back at it again, and we're going to talk about dividend yield trap, how to avoid and fake high dividend opportunity. Now, in this video, I'm going to go over 3 different scenarios, so stay tuned, like and subscribe to my video, and I will show an example at the end of the video.
See that mouth-watering dividend yield? It could be the bait that empties your wallet. Because when yields look too good to be true, they usually are. Here's the red flag most investors miss and how to dodge it. A crashing stock can make the yield look massive, but that's often because profits are tanking. A better move? Start with healthy, growing companies and let sustainable dividends follow.
But let's first talk about dividend yield. Dividend yield is when the company pays you a portion of their earnings so that you can get some money. It's a passive income. And here's a better example or better explanation right here.
I'm researching Coke stock and the dividend yield is 3.21%. What does that mean? Oh, well, you know what a dividend is, right? Yeah, it's a portion of the profits that the company passes back to me just for owning the share. Yeah, so the yield is just dividend divided by share price, but it's represented as a percentage. Okay, so if Coke has a yield of 3.21%, how much am I getting back for investing $100? Oh, you'll get 3.21% of $100 invested, so $3.21.
Now, let's talk about this and why is it so important. Now, dividend is a very attractive situation. They pay you to own the stock, and a lot of people fall for the high yield dividend trap. And I want to show you some examples of a high yield dividend trap so that you can see what I am talking about so you can understand the examples. Now, let's talk about what we look for and understanding what is a high yield dividend trap. So first thing we need to do is understand dividend yield trap. So most investors often seek income generated opportunity, and high yield dividend naturally appear more attractive. So however, many companies advertise inflated dividend yield to lure investors, even when their financial health is deteriorating. So it mislead the investors. And this is where I say you need to stay safe and be smart about high yield dividend stocks. Now, number 2, why extremely high yield can be misleading. A significant number of high yield dividend may look appealing, but often indicate trouble beneath the surface. And most of the time the yield appears high because the stock price has dropped sharply. And this is the thing you want to watch out for. Number 3 is the danger of weak cash flow. Dividends are sustained only when companies generate considerably consistent and healthy cash flow. So a company struggling to maintain sufficient cash flow, that means the dividend payout becomes weak and unreliable. If you're looking for dividend stocks, you want to make sure you purchase a reliable dividend stock so you don't have to keep changing out. You want to make sure it doesn't lose value and all these different things. So, number 4 issue you may see is payout ratio, a critical red flag. That means if the payout shows potential earning company distribute as dividend, it looks fishy. How are your payout ratio this high compared to the earning? And this will cause a dividend cut, so you'll lose money. Number 5 things you need to look out for is the debt level and balance sheet strength. So companies with high debt loads may try to maintain high dividend payout as a tactic to attract and retain investors. But if you look at the balance sheet, it's not possible to sustain. And number 6, why sustainable dividend growth matters. It's truly reliable dividend strategy. It's not building on high number, but on consistent growth. And those are the things you need to watch out for. And here's the thing. The definition of a dividend yield trap is a situation where company stocks appear to be attracted due to high dividend yield, but it's misleading. That's the big feature. And here's the 3 key characters so you understand: high yield dividend, falling stock price, and weak financial fundamental. Those are the three things you need to watch out for. And I went on and on earlier, but those are the key characteristic of it overall. And how, let's first talk about how, well, let's talk about how to avoid dividend yield trap before I show you the example. And the first thing is you conduct your due diligence. Investors should analyze the company's financial health, including earning, trend, payout, before investing based on solely dividend yield. The next thing you need to watch out for is to avoid is monitor earnings and revisions. Keep an eye on negative earnings. If they have a negative earning and a share price is sentiment as to indicate potential issue of dividend sustainability, it's gonna cause a drop and it's not worth having. And last thing is compare within the industry to see if it's too good to be true. One company giving 50% dividend yield and another one's only giving 5%. You need to understand why it's the difference, and that's why how to do the comparison. So before I put it on the screen, I want to go over each one of them so you can have a clear understanding. Is the first one I'm gonna go over is NEP, or Next Era Energy Partner. When you analyze this stack, it seems to be okay. And the analyst is warning this dividend cut is coming the next year. If analyst is warning you that they're going to be doing cuts, and they have a high dividend payout, this is not a company you want to buy. And the other thing that Next Energy Partner has issue with is highly leveraged and slow growth in the renewable projects. So this is the thing you have to look out for. And lastly, the yield looks attractive, but it's not sustainable. So that's the first one we're going to look at. And I'll put this on the screen again. I just want to go over it first. And the number 2 is Annually Capital Management, or NLY. Earning has fallen dangerously close to the current dividend levels. The second thing, as a mortgage REIT, is highly sensitive to interest rate. And lastly, the high yield is masking the declining earning powers. And we'll see this more whenever we go over it. And the third one we're going to go over is Community Health Trust, or CHCT. And the reason why this company is going to be an issue, has a major tenant is in financial distress, creating revenue loss. So potential dividend cuts. And it's a healthcare REIT that heavily relies on tenant stability. So those are the 3 stocks we're going to go into. And here's the thing. NEP has expecting dividend cut. And why is the problem? Cuts is usually triggered by sharp pricing drop. NLY. Earnings are barely covering dividends. So unstable payout leads to volatility. And CHCT, main risk is tenant distress, so threaten the cash flow of the company. So those are the 3 we're about to go over, so you can see it one by one. Now, the first red flag you have to see is Next Tier Energy. The company has been marked as potential delisted and may not actually be traded. So, red flag. It is going to potentially be at a loss from a stock trading. And the dividend yield is 34.82%. And that sounds great. It's growing 34.82%. But they possibly got delisted and they possibly can cut your dividend. So this is an example of what you need to watch out for. The dividend sounds good, but you have a company that has been marked as potential delisted and may not be actively traded. It's a red flag. It all sounds good, but guess what? This is a red flag because the company possibly get delisted and you can't look them up on any of the other websites like MSN. I tried. Now, the second one we're going to go over It's Annual Capital Management Inc. Remember, the problem with this one is that it's losing value and it might not be able to maintain its current level. And right now, if you look at the 5 years, it looks like it's recovering. It looks like it's doing pretty well. 1 year growth is 26.99. 3 years is 3.55. So the red flag for this, the dividend yield is 12.04. This looks very enticing to buy. Personally, I would have fallen for this trap if I didn't look at the finance. The last year, it was a negative 58% gross margin with a net profit of negative 67. So they shouldn't have grown. So this fluctuation where negative, positive, positive, negative, positive, it looks like they might be in trouble. So you have to always check the cash flow. How well have they been doing? Have they been doing well? Because you want to make sure they're not going into the negative. This is why you need to check the income statement, the balance sheet, and the cash flow. Because they took a large amount of money, it makes them look good, but this company is highly volatile based off the stock market or the interest rate. So this company has an issue with the revenue. And you won't notice it. But if you look at it, gross margin, operational cost, return on equity, you know, this is looks like a great company to buy, but at the end of it, this is the reason why it's a red flag, because it looks like it's returning, but financially they're not stable and they could cut it any time. The last one is Community Healthcare Trust Incorporated. They have a dividend of 11%. And they're declining on stock price. That's a bad sign. 3 years. And the news has been stating that it is losing its financial stability because healthcare cannot pay them. Because the people they have in there, their tenant is not going to be able to pay. And their financial health is not doing so good. You see right here, it has a negative return compared to everyone else. So that means their high dividend yield is not going to be sustainable. And look, last year, they lost a negative 2.75%. And this is why I say, hey, don't buy them because they're having issue with their money. So like and subscribe. Those are my 3 examples. The second one was a little tricky, but hey, you need to do due diligence so you don't fall for these high dividend yield traps.